afternoon, everybody. Good morning, depending on where you are, I guess. Welcome to our Tuesday Lunch and Learn session. And this week we have Scott Myers with us from Kingdom Self Storage. Scott, appreciate you joining the group here and introducing us to your business. Feel free to go ahead and introduce yourself.
All right. Thanks, Chad. Should I launch in, or do you have anything else that you need to go over before we head into the meat of things?
No big thing. I guess I will throw out there, if anybody has questions during the presentation, feel free to dump them in the chat and we'll manage them as we go through or at the end. But outside of that, nope, we'll turn it over to you and let you run with it. Appreciate it.
Awesome. Thank you, Chad. And thanks to all of you for hanging out and talking about my favorite topic, which is self-storage. Yeah, it's an unsexy asset class. I'll just say that right out of the gate. But you know what? After looking at the other asset classes and investing in most of them, you know what I found is attractive, and that is cash flow. Simple, predictable business models in real estate that produce income consistently, whether it is we're in a recession or whether we are in the boom times. That is what is attractive about this asset class, and that's what we're going to be talking about today. I love the asset class. I've been in it for a number of years. And wouldn't you know it? Just as we said, Chad, technology is great when it works, and I'm frozen. So let's try this instead. Maybe if I just do this, that I can get it to work. Hold on a second. Will it advance? I can't get it to advance. It won't advance. Bear with me just a second, folks.
Yep, no problem.
I wonder if, let's do this. Maybe if I switch screens. And Chad, do you have any good self-storage jokes that you can share?
Filler discussion here.
Yeah.
You know, I'm only involved in one self-storage deal so far, and I've been very happy with it. So I am excited about the asset class. Always love to learn more. So
good.
We may have to have you act this out like charades for us.
Oh man, let's hope not. Let's hope not. So let me try this. If we can get it to. It just does not want to advance.
Can you walk through it just in the slideshow? It was coming up pretty good when you just had
it was, and I think that's just what we're going to have to do. So gang, that is not the ideal way of doing things, but that is what we're
left fielders. We're used to doing things a little differently. So
well, you know, that's good to hear. So let's do this. All right, so we're going to bring this over here.
Clearly, you must be a gearhead too.
Oh, let's expand it. I am, yeah. Okay, let's see. Okay, so now,
if you jump ahead a slide and try to start the slide presentation again, if it'll help.
Well, I don't know. We'll try it that way, but if not, no, it doesn't. It just won't advance. So we're just going to do this. All right, gang.
It comes up clear enough there.
It does. Now, but everybody's going to be jumping ahead. Hey, Jim. Hey, Carrie. Hey, Craig, Tom, Peter, Brian. Really, really good at self-storage, maybe 90% on the technology side, but that's not what we're here for anyways. So a little bit about my background. And again, thanks to Jim for, first of all, for all that he does for the community. Guys are rock stars, you guys all know, and very thankful to be a part of the left field community, and was thankful to be a part of the gathering, the first gathering back, and just a top-notch class act. Jim is one of those few people out there, and there are a few people. I've been around the block a while. I've been teaching and on the kind of speaker circuit and educating people in addition to investing for 18 years now. And there's very few people that really have a heart and a passion for making sure that people are successful and not looking at it as a business. And if you know anything about Jim's business model, it's about helping first and foremost, rather than a business. And so it's a rare breed, and you guys have hitched your wagon to the right guy. Not only Jim, but the rest of his business partners and the team of staff and volunteers that help out. So just wanted to make that known because you guys are in the right place. So for myself, my background, got involved in real estate back. It's been this is my 30-year anniversary, 1993. I bought the Carlton Sheets home study program. Some of you may remember that and his infomercials. Bought it off an infomercial, put it into place, bought that first single family rental house and did the Burr method before it became the Burr method. Rehabbed it, rented it out, refinanced, and then went out and bought 2 more, and then ramped things up. But recognized that I didn't really have the freedom and the cash flow that I was looking for, that Carlton talked about. He's on the beach interviewing everybody else. And so we wanted to, economies of scale, we figured would fix it. So we got into multifamily as well, which is just a higher form of residential. And all that did was really just kind of increase our headaches and still not as much cash flow and not as much free time. And so I got into then self-storage. I began looking at the asset class because I thought, wow, how do we make a bunch of money in real estate? Because we love real estate for leverage, appreciation, depreciation, and we love rental income real estate, rental producing, because they pay off your asset for you. But what do we do without tenants and toilets? How can we do it? Well, that's either self-storage or parking lots. And parking lots, you can't create a lot of value in, but self-storage, you can. And so I began to learn about the asset class and never looked back. We sold everything else off. To date, since 2005, when I got in storage, we've bought, acquired facilities, converted industrial buildings into self-storage, developed from the ground up. Now 16,000 units. I need to update that, and approaching almost 2.6 million square feet nationwide. We've raised over $60 million from our 450 private equity partners. We have a large following of folks that invest with us, but 450 of those are very, very active in our projects. I do speak for the industry. I've been writing articles for Forbes magazine on behalf of self-storage, the Inside Self-Storage trade show and conference. I speak there almost every year, Self-Storage Association at their conferences as well. And so if you Google Scott Myers and self-storage, you'll find I'm out there quite a bit. We've been doing this for quite a while. So in 2007, we founded a national coaching business, and we started teaching people how to get into the business as well. And before I knew it, this was it was more of a calling and a mission, as I used to run an investor group and then begin teaching people about it, I guess, similar to what Jim and the guys are doing as well. And then what I found is that before long, I had 2 60-hour-a-week businesses, and something had to give. And so since then we've kind of scaled back the education side, and it's more consulting and a mastermind of folks that are doing the business. I love taking people from 0 to 55 miles an hour in the biz, but I shine, and my strong suit is 55 to 100 miles an hour. And so I spend more time on our mastermind and guiding these A players, corralling these A players, but we're doing business together. And so that's how we kind of come full circle. So I am an experienced investor. Again, 30 years. I've been through 2 recessions and I'm ready for this one. One of the biggest regrets I have in my business is that in 2008 and really prior to that, is that I didn't create enough lending relationships and private equity partners, or grow a group of folks that we were teaching and showing how to invest the way that we do. Because at that time, my friendly competitors, they gobbled up a whole bunch of assets when they went for sale. And not that self-storage got burned during the recession. It did very well, but there's investors that were investing in other asset classes that got burned. They were in multifamily, they were in assisted living, they were in office, they were in retail. And, when they went bankrupt or had to sell their assets off, the last to go was their storage facilities. And they were 90+% occupied and, just spewing out cash, but they got wrapped up in a bankruptcy or in a short sale. And I didn't have enough cash to go buy all those. So lesson learned. Nobody celebrates a pandemic, nobody celebrates a recession, but we're excited about heading into this next one because we know that there will be opportunities for us to be able to partner with folks and perhaps even buy some of those like we did last time around. So we do this for multiple reasons, meaning self-storage. I quit my job because I'm not quit my job at AT&T and Lucent Technologies because I'm just not a good employee. I think I'm always meant to go out and be on my own. But then also it was by design, to get into real estate, because real estate is a vehicle that if you do it right, will provide a lifestyle that you can be present for your family, for yourself. You have freedom to be able to do things on your own terms, and the cash flow, it is a great wealth generator. And one of our missions from the beginning, our first and foremost for my wife and I, is that we were going to raise our kids. We homeschooled them, and we were going to go to Washington, D.C. rather than having them read about it in a book. And we were going to spend time in the mission field and travel the world. And we were able to do that. And then we began our give back. Is we've always had a passion for those who don't have an opportunity like we have here in the U.S. And so we've gone to Dominican Republic and Mexico, and we've done a number of different mission efforts and charitable efforts. But we've really focused now on building houses in Mexico, in Ensenada, Mexico, and we give them away. And we take people on these mission trips with us, friends, staff, students, coworkers, and we pay for the whole thing. We pay for the house, we pay for your trip. Anybody that wants to come on a trip with us to experience a short-term family-friendly mission trip, then we make it available so that they have their own experience. And then also in hopes, perhaps down the road that somebody will be touched in a way that they will go out and they will start their own mission within their own organization or at home or in their own communities or church. And just if we can be the model and the catalyst for that, then that's what we do. So 10% of all of our profits and all our businesses go towards building houses and taking people on trips. We built 26 houses to date. We do about 6 per year. We're getting ready to do probably 4 per trip now, 2 trips per year. So we're going to ramp that up to about 8. With the ultimate goal in lifestyle design is that my wife and I will flip the script, and the 80-20 will be reversed, and 20% is spent in the business and 80 on the mission field, where we're about 80% of the business right now and 20% on the mission field. And it's incredible. I could go on for an hour to talk about what we're doing here, and not what we're doing, but just the impact that is being made through us, through our business, and the folks that we take on these trips. It's been incredible. If you haven't taken a short-term family-friendly mission trip somewhere, I strongly encourage you do so for many, many reasons. All right, so let's talk about where we're at. I've learned a little bit over the past 30 years in real estate, and I've learned from recessions. We learn from adverse times and through adversity. And so the first recession I went through was the dot-com or the dot-bomb recession, March 2001 to November of 2001, and many people here probably remember that. And that recession was defined by, and we talk about recessions in terms of negative GDP growth. Or decline. And so in this one, we had 8 months GDP decline of 0.3% and 5.5% unemployment. So officially in a recession at that point. The cause was the collapse of the dot-com bubble. That's what sent us into the recession. The Fed raised the fund rate from 4.75 to 6.5 from 1999 to 2000, which obviously slows growth as well. And then the September 11 attacks sent the economy into a tailspin, and then we were officially, deeper into the recession. Then the Community Reinvestment Act was spurned in the next administration. It was kind of revamped, resurrected and revamped. And what the Community Reinvestment Act is designed for is to be able to put investment dollars back into these neighborhoods and areas where people may not have an opportunity to get a house. Well, they went a little haywire, as many people know, and basically anybody that could fog a mirror was getting into a home, and at some crazy valuations. And so our tenants that were in our houses and our apartments, they bought houses, and who could blame them? Best time in American history they could do it. And so our business tanked at that point. We did not do well during that first recession. And to the point where I had, the grocery store incident where we were robbing from Peter to pay Paul until Peter was out of money as well, when we had rehabbed these houses and the apartments once to then reposition them as better houses and better apartment complexes, and not necessarily regentrifying or an area, but we were stepping them up from a C+ to a B- in class, or a B or a B+. And so now we had to try to sell these things off, because now people were buying them, and so we had to rehab the houses all again. And that was very, very costly for us to do, and took us to the brink of bankruptcy. And at that point, I realized that I didn't want to be in that side of the business anymore. So my wife said, well, how about we look into self-storage? And this was the second time she asked. And the first time I was too prideful, because we were in multifamily and growing that side of the business. We had office buildings, we had warehouses, and I couldn't be bothered with these little garages on concrete slabs until I looked into the asset class, and loved what I saw. It has the lowest loan loss rate, lowest loan default rate. It does extremely well when times are good. People buy more stuff in this country. We are the hyper consumers of the world. And when times are bad, we head into a recession or a pandemic, people downsize, businesses downsize, and all their extra stuff goes into storage while they regroup as a business or regroup as individuals after they moved in with friends, family, back home, whatever that looks like. And so we actually storage as well, up and to the right during good times, but the hockey stick effect during a recession. We're usually top 5 in terms of sectors of the economy that benefit from a recession. Alcohol is always number 1. You can chuckle, but it's true. And storage is somewhere usually around 2, 3, 4, and 5. just because of what we see in our industry, while the other asset classes, and I'm not here to beat up on them, but everything else goes down, from multifamily to assisted living to retail, office, everything else, as we've seen every single recession. All you need to do is track it, and you look at the numbers. Storage goes up and the others go down. So at this point I said, I'm out. We're getting into self-storage. Found a mentor, got to work, sold everything else off, and self-storage basically found me. I didn't find self-storage. It was more of a self-awareness journey, recognizing that we built a pretty good business and we were doing well, but when the economy hits, and you're just a victim and a passenger, no matter what you're doing as a landlord and an investor, then I realized that, okay, here's my strong suit: simple, predictable business models, and growing a smaller staff that doesn't have to go through this. And I'm not good at firing people. I'm not good at evicting people as well. I mean, we did what we had to, but I still didn't like it. So we moved on from that asset class, and then we moved into an asset class, a business that we can run unmanned. So I don't like tenants. I don't like toilets. I don't like trash, and I like people, but I don't like to manage a whole lot of people. We had a big staff, and people just cause issues. Staff causes challenges. I mean, that's day in, day out. That's we're just dealing with people and the challenges they have in their lives, bringing it into the workplace. So anytime that we can reduce in a business where we can reduce the amount of headcount and or even clients, customers, people that we have to deal with, it's a good business model. It just is for us. Again, self-aware. This is myself, and looking at it as an investor, investing in almost all these other asset classes. Number one challenge is not getting paid by people and then destroying our property. Bottom line, and employees not showing up, lying, stealing, and all that. That's it. That's, businesses would be easy if it weren't for people. So I got into the business that they had the least amount of people. So we don't have tenants. We just got people that store their stuff. And then we have kiosks that manage the facility. And now we have people that go in and check on them. We don't take cash anymore. So they used to pull the cash out of the kiosk. Now everything's electronic, and we can rent a unit with the use of our phone. Now the business is on a phone. We do have kiosks at our facilities where they pull up, they walk into this vestibule here, this concierge area, or the reception area, and they can walk into these units. There's signs, and in some cases we have video screens in there. It's got all the sizes of the units so they can see what it looks like. I don't have to have somebody who happens to show up for work that day put somebody on a golf cart and drive them into the facility and show them the units that are available. They get to see it all right there. With a couple of clicks of a button, they can rent a unit with their debit card, with their credit card. We also sell locks and moving supplies from a kiosk as well, if they've forgotten anything, cylinder locks or a key fob, or just plain access to get into their unit, all without coming into contact with a single person. So without going into the technology, I'm not a techie guy, clearly, because I can't even figure out how to use PowerPoint on a Zoom. But our facilities are 90% full, and we have very little staff, and in many cases, no staff at any of our facilities. So the business model is a strong one, where people can get onto a phone, and it's important to note that for those that are new to self-storage, this is a commodity. When people need storage, they don't desire it necessarily. We're in the trauma and transition business. People usually don't come to us unless their hair's on fire because somebody died, somebody's getting a divorce, or somebody was cheating and they got kicked out, or the basement flooded, or they're moving, and sometimes that's good, but it's a hassle when they're moving and they're cleaning out the house to make it look better for the the realtor and people coming through. So all their stuff goes in storage, and then when they move, they put more stuff in and rent another unit, and then they rent storage again at the new location. And then when there's a recession, when there's a pandemic, when everybody came home from school and from work, everybody had to clean out the spare bedroom, the dining room, the basement to make room for school and work. And we were the benefactors of that. It was not a happy time for folks, but we are in the trauma and transition business, and we are happy to serve those people when they come in, because typically we train our staff very well at our facilities that have staff. Guess what? 9 times out of 10, when people come in, you need to love on them. You need to listen, because they got stuff going on in their lives right now, and we have to be extra accommodating. They're not going anywhere. They're there for a reason. They don't want to go shopping around. They're not looking for school systems. They're not looking for landscaping and checking their neighbors. They're not going to live there. They need a place to dump their junk and move on, because that's one less thing that they need to do that day. And so we make it easy for them to do it online. When they're searching around on a phone, what's closest to me, get on the website, what looks safe, clean, well lit, a place where I want to put my stuff, and can I rent it right now so I don't have to go shopping and price checking and doing anything else? That's who wins the game in self-storage, and we do that better than just about anybody. We have all the SEO, SEM staff that anybody could ever imagine within a firm to make sure that through the geocaching and everything else, that people find us when they need us. Because if they walk into our facility, you got to pry them out of my cold dead hands. There's no reason they should ever leave, turn around if they don't, unless they rent a unit. They're not there because they're shopping. They're there because they need to be. And when they're calling and when they're clicking around, we need to capture them, and we need to make a phone call or answer the phone immediately. There isn't any phone number in any one of our organizations at any site that does not go to a live person. It rolls. There's an outside chance that it may go to a voicemail, but they need to get on with a live person. That live person is selling them for the appointment. They're selling them for the rental. They're selling them for the next steps, because otherwise, if they're gone, they're gone. So that is what we love about the industry, is that sense of urgency that is created, and we do that better than anybody else, which is why I love that. Our funnel is strong, and our tech and our people are strong on that end. And so long as they hold up their end of the bargain, we don't have to have a lot of staff managing people, because if they don't pay, we don't go knock on the doors, we don't send letters, they get a notice by way of email, and on the 6th of the month, they're locked out. And if they do not pay, then we have the right in every state to auction their goods off, whether it be in 60 days or 90 days. All the states, the lien laws are roughly the same. So if they don't pay, we put a lock on their unit, or on our electronic facilities that are more tech savvy. There's a lock that's on the inside of the unit that just locks them out. Their key fob doesn't work anymore. Their code doesn't work anymore, and they can't get at their stuff. If they want their stuff, they got to pay us back rent and late fees. So that, as you can imagine, for those that are either investing in or passively investing in multifamily or anything that's residential, that accounts receivable is awful, and it accounts for so much, rent loss in the business. Well, our rent loss is less than 5% across the board, because people know we're going to sell their stuff if they don't pay. So they pay. And if they don't pay, we sell it. And then we recoup our back rent and our late fees. Not 100%, not all of it, but we have the ability to do so, which is far different than what we had in the residential side, the habitational side of real estate, where I go to court. The court sides with the client who destroyed my property and stole from me by way of non-payment of rent. Lovely term in court. And I walk out with a pink piece of paper and almost no ability to collect the rent. Well, here I am the judge and the jury. And that's a better place to be, because I am the owner. I do charity work. We build houses, we give them away. I don't need to give away free rent and self-storage for somebody who has the ability to come up with $100. That's just the way it is. All right. Great recession number 2. Folks, I'm going fast because I want to leave time for questions, because I know we get a lot of questions about this asset class. So I'm leaving time for that. I'll make this available as well. So Chad, Jim, so you can go through this as well. But I want to get to the question part. So we'll talk about the second recession and what happened there, the great one. Great recession. Those bad loans from my tenants who could fog a mirror all defaulted. The GDP declined by 0.3% during this recession, and unemployment skyrocketed to 10. So every recession is going to be have a different flavor to it, and there's going to be there's multiple factors that send us into a recession, and each one is what sends us into a recession is a combination of different ones, and this one's just a little different as well. But in this case, self-storage flourished, because when Lehman Brothers fell, we dropped off a cliff. And everything shut down, and businesses shut down, and people were losing their homes the deeper we got into the recession, because it was a finance issue, and the banks weren't lenient. They weren't pulling any punches. If you didn't pay, they're taking your property back. And so we had a whole bunch of folks coming in with their hair on fire that we were helping. And it was a sad situation, because they lost their homes, and they were having to move in with someone. But the industry is, we're in the trauma and transition business, and we flourished. We bought, developed, and converted everything we could get our hands on at the time. And it still wasn't, well, it's never enough, right? Yeah, as every investor will tell you, how much is enough? Well, I don't know. Let me tell you, but probably just one more. And we began laying the groundwork for this one. And the idea was to get more cash. So we have cash. We've exited a number of properties. We are liquid heading into this one, but we more importantly is we have a group of rabid self-storage fans that we've made a whole lot of money for since the last recession. We bought and sold at the peak. We do our own feasibility studies along with third party. And we hit our marks almost every time. We exceed those. Our average returns for our investors is 34% against our projections of 26, and an industry that produces 16.85%. And so these folks are ready to invest with us heading into the next one. And so I love this. I love this industry for so many reasons. And as we head into our Super Bowl now that we're heading into, appropriately enough, this time of year, the opportunity is that 80% of these facilities out there are still owned by mom and pop. So the great roll up is on. We're the last industry where it is so lopsided in terms of REITs owning 20% and the rest being owned by mom and pop individual investors. All the other asset classes, it's the opposite, where REITs own 80 to 90%. And there's very little opportunity for investors to get in and snatch up what's left. And so we're buying them. We're rolling them up, selling them off to the REITs, keeping them for ourselves, running them as a fund, running them as a portfolio across the country geographically. It's a great land grab for us right now. And that's what our focus is on. This is the highest demand and the fastest growth sector in the country. We've built more square footage of self-storage in the past 20 years than any other asset class, period. It's the easiest to fund. SBA, private equity, they all know, lowest loan default rate, lowest loan loss rate, and the highest returns compared to all the other asset classes. And again, I'm biased, but I'm not biased. I'm only biased because I got into the industry after investing in all the others. And I looked at the stats, and that's why I jumped in. So all you need to do is look at the asset class compared to everything else. It is the strongest, period. Highest cash flow per square foot compared to the other asset classes because we raise rates every 7, 8, 9 months or so. And our expense ratio is only 30% compared to 50% for multifamily and office and assisted living, which is almost a 60% expense ratio. It's a metal box on a concrete slab, folks. It's just, we don't have high operating costs, and our accounts receivable, as we mentioned, are in check. It's the easiest to manage. It is. I can say that because we can run it with a kiosk. We can manage it with a kiosk. Now we have district managers and regional managers who go to our sites and obviously make sure that everything's good and in check and in working order and cleaned. And we have staff that goes around and handles all the rest of the maintenance and what have you. But it is the easiest to manage in terms of the cash flow of the business itself. Passive income, multiple profit centers. So when I say passive income to this group, passive income at our storage facilities, at the storage facility level, we sell locks, boxes, and moving supplies. We sell renter's insurance. We offer U-Haul or other company truck rentals, and it's an agency relationship where our managers, or U-Haul has a kiosk as well that they set up at our site to rent units, and we get a commission for that. Vending machines, concierge services for boat and RV, propane filling, detailing services. There's a number of different furs, art, wine, other collectibles in temperature controlled storage and humidity controlled storage. Record storage is another business within itself. eBay drop shippers, Amazon drop shippers, a number of different ancillary passive income streams that we add to our facilities that forces the appreciation and the value with very little or minimal involvement by ourselves. That's another thing that I love about self-storage. Rounding out my top 10, no tennis, no toilets, no trash, coming from the other asset classes. And again, I'll never say it's recession proof or inflation proof because no business is, period. It's not proof, but is very resistant. And we as an asset class and self-storage do better as an asset class. All right, so what does this look like? Is this all just theory and, all those numbers that Scott put up there? Is he really walking the talk? I put together a case study for you folks. Here we go. This is what it looks like in practice. This is property that we're in the middle of right now, project we're in the middle of closing on. We found it at an online auction site by our acquisitions team. We purchased all cash in 35 days at an 8.5 cap with a 70% vacancy. And this is a strip with an anchor with Aldi as the anchor located in Canton, Ohio. Purchase price, $1.5 million, $23.67 per square foot. We can't build it for that. Nowhere near that. It's about double that now. Gross square footage, 63,365. Current rentable, 54,666. The land area is 5.7 acres, which we're really excited about. We're getting income from the current tenant, lender like that, from Aldi's. And then we're going to convert the balance of it to all climate-controlled Class A self-storage. Very strong pro forma creation because we did our market studies and we looked at the demand study, the supply index and market rates. And this one's going skyward. Built in 1990. Renovated in 2022 to be able to sell, and that's the shell, which is a good. We're still going to do more facade work on it to make it look more like storage, And those plans, those renderings are being created as we speak, and then we will convert the inside to self-storage. So this is a sampling. We're putting together our offering for this to put out to our group of investors. And so we highlight the reasons why we like it. 1.5 million, year built in 1990, PB4 zoning with a variance for storage, 5.7 acres, one building. 450 plus units is what we'll end up with. Average unit size 100 plus or minus, and then 121 parking spaces for boat and RV, which is also in high demand in this market, as most markets around the country right now. So our desktop study, our market study came back very strong. We do this again with a third party, especially when we're raising private equity. And the population, a 3 mile radius is 55,580 with a 5 mile radius of 129,205. For those that are new to storage, we'd like to see a 5 mile radius of having 80,000 or more is ideal. We're sitting at 129,205. We like to see a median income of 45,000 or greater. We're sitting at 60,000. And a supply index, this is one of the bigger numbers that we hang our hats on in terms of going forward or not with a project. And we like to see between 7 to 8, depending upon the market, square foot of self-storage per capita or per person in a market. So within a 3 mile radius, if there's 7 to 8 square footage of self-storage already in place per person or per capita, it's approaching equilibrium, all things being equal. That's just kind of a standard industry number. It's out the window when we go into other states like Florida. I mean, it could be 10 or 11 because there's no basements, because there's so much water and density and things of that nature. So we need to check the competition, but that's kind of a rough number. A 3 mile radius supply is 3.2, and our 5 mile is 4.1, clearly below the industry average. So that's what has us excited, and that's what comes. We love conversions more than anything because these infill locations is already there. The cities they don't necessarily like new development. They don't necessarily like self-storage coming into another location. But if it's already zoned, or we can get a variance and it's vacant, and we've got everything in place in a shell, that's just ideal for us. Run rate in the market, very strong, 165 up per month for a 10 by 10. Without getting into all the math, that is strong. That is strong. We'd like to see 10,000 or more vehicles per day in front of a facility. That is ideal. This has 27,000. And, as a, excuse me, a wise old self-storage developer friend of mine that taught me 20 years ago, a very key lesson, a very scientific approach to looking at sites to develop a self-storage facility. And he said, I ain't going to build no facility unless I can see Walmart and smell McDonald's. And so we do have a Walmart right here, and we do have a McDonald's right there as well. So it passes muster, and with a high vehicle count as well. Significant upside, as we mentioned, and we're buying it for less than half of what we can build it for. Supply index is strong. Rental rates are strong. Current cap rate going in with the current income just from Aldi is 8.5. Current NOI, excuse me, 100,000 a year. Our 3-year NOI projection, 300,000 plus. 6-year NOI projection, 525,000 plus. And so again, I'll share this with you. Whoops, the only numbers that we need to be concerned with is our IRR, project level 37.28%, total profit of 4 million, total equity of 1.6 million, and an equity multiple of 3.39. Excuse me. Unleveraged IRR 17.49%, levered IRR 37%, again equity multiple of 3.39, and our return on cost of 7, total profit of 3.9. So we underwrite very stringently. We have a third-party company that backs up our numbers before we send anything over to our lenders and to our private equity partners. But without, again, teaching everybody about the business, that's not the reason why we're here today, but to show the opportunity and the approach that we take to the business and why we're so interested in it right now, and a flavor for, the types of assets that are out there and that at least that we're focusing on. So we're excited. The time is now. And the time is now to invest. I know there's a lot of folks that are sitting on the sidelines, and we will never push anybody to do anything. But if anything, encourage and just maybe bring to light, wherever you think inflation is at right now, it's usually a couple of points higher than what the federal government is stating it's at. But if you're not earning more than that right now, if you're sitting on the sidelines, that's not the best thing to be doing. So this isn't a plug to invest with ourselves or doing anything. As a matter of fact, we make a promise on these not to do that with Jim. And Chad, so I'm just stating that, guys and gals, you should be doing something. If your money's sitting on the sidelines, it's not the best move. And besides, if you're active investors in real estate as well as passive, absolutely now's the time. More millionaires were created in real estate during the recession. So when people are running out is when it's time for us to be running in, says Warren Buffett. Even, yeah, he is a real estate guy. He's also a self-storage investor as well, one of the largest in the country. Now's the time. The market is changing, and major shifts in the market mean we need to shift gears. We're shifting into high gear, and yeah, we're going out and finding everything that we can get our hands on that pencils and makes sense at today's capitalization stack, looking at our cost of capital and how much it costs for us to deploy that capital. But our underwriting hasn't changed. Our model hasn't changed. We have our parameters and we stick to them, our guardrails. The only thing that's changed is our cost of capital. So we plug that in. If it works, it works. If it doesn't, it doesn't. But right now we're finding a lot that's working. And so we are excited because as Wall Street Journal has shown, investors are flocking to self-storage. They're not living in them because that's illegal, but they're flocking to the asset class. There's 4 ways self-storage is recession resistant. Plenty of articles out there for you to dig in a little bit further. Multi-housing news, they can't help but report on how well our asset class is doing because it's outpacing multifamily. That guy wrote an article about self-storage in Forbes, and he just went through most of those things in that article as well, but you may want to check out that article as well. Bloomberg, again, I'm just not biased on the asset class. I'm biased, not biased. Best U.S. real estate investment, self-storage, bar none. It just outpaces everything. Self-storage is pandemic's hot property, outpacing everything else again. We love the asset class. Red hot, rents, valuation soar as the sector keeps growing. We have not surpassed that. If you all, those of you that are passive investors, you're probably following NAREIT, if that's the way you pronounce it. If you have another way or the proper way, let me know. But if you compare self-storage, this is the reason why I got into the asset class. I'd rather be, one of the school of fish swimming in the right direction that's going the fastest and doing better than the lead guy out in front testing something else. 25-year average annual returns, self-storage has outpaced, again, everything else in commercial real estate as an asset class, 16.85%, industrial at 13, healthcare at 13, multifamily down at a little below 12, and retail office in the S&P 500. The downside protection, also what we saw in self-storage, 2007 to 2009, self-storage had a negative 3.86% growth. So we actually grew during that time. So our company bolstered that. 6.72%, retail at 12, office at 8, and S&P 500 at 21. Again, not trying to beat up anybody in multifamily. I was in multifamily, made a lot of money, and also lost some money. However, it's most commonly compared, self-storage is most commonly compared to multifamily. So if you look at investing $100,000 in self-storage in 94, outperformed multifamily, outperformed it by 2,215,650, and the S&P 500 by 3,494,170. So those aren't, that's not just my advice. It's not just my bias. That's the actual stats. So we're excited about the asset class. It's been recession resistant because demand for storage space is based on life events, as Brian Somoza with JLL Capital Markets. They do a number of our feasibility studies for us, and they really track, they track commercial real estate better than just about anybody out there, in my opinion. Businesses and individuals will downsize as we head into the recession, and their extra stuff goes to storage. We know that. Private lenders are pulling hundreds of millions of dollars from Wall Street. You know that because that's some of you. Sellers of self-storage are grabbing cash by selling their properties right now because it's the hottest asset class out there. People want on the balance sheets. Storage is essential. We didn't close during the pandemic and consistently outpaces all other asset classes I just showed you. So the solution, I don't know that there's a problem or what you're looking for today, but for us, it's, we're not going to miss this perfect storm. The solution for us is last time is that we did. And now perfect storm is here, and we ain't going to miss it this time around. That is for certain. So with that, Chad, I'm going to turn it back over to you. Take a breath and see who has questions for us that I can answer about self-storage.
That's great, Scott. Thank you for that. Glad to clarify that the investors aren't living in the storage units too. So thank you for clarifying as well.
That is illegal.
Any questions, again, feel free to jump them in the chat or unmute and ask. We do have a couple. The first one you really, I think, answered. I think David asked it prior to you covering it, but he says, I assume no U-Haul or ancillary sales, i.e. boxes, etc. But I think you spoke to actually you do.
We do.
Yeah,
we do. Yeah. Let me make out one clarification. We sell lock at our facilities that are unmanned. We could still rent trucks. U-Haul has a kiosk for that, and we have kiosks for locks and some small moving supplies. But those are the facilities that typically 55,000 square feet and less, where it just really doesn't warrant the payroll of somebody there, either part-time or full-time. And so we run them unmanned. So what you do give up, what you gain in payroll, you do give up in that ancillary income stream. But it is, as you can imagine, we wouldn't do it if it wasn't more beneficial and more profitable to not have the payroll for the amount of money that we gain in the ancillary income streams.
Yeah, and in the case study you shared, you showed that it had an anchor store with Aldi there.
Yes.
Is that a typical strategy of something that you try to do, or just scenario?
It's not typical. That one worked out, and in many cases, somebody's selling off the anchor. The anchor's struggling. They went out, and it's vacant, and then there's a smattering of the retail businesses that are still in play at a struggling retail strip center. In this case, all these long-term, lease, Class A tenant, very, corporate tenant that, triple net lease will get income from that. And we bought it based upon the NOI on that and got the rest of the building for free. So it's the opposite. We were the benefactors. Every once in a while we get really, really fortunate. I wouldn't say lucky.
That's probably a great scenario. Yeah.
It was a great scenario for us. Yeah. It was a fantastic, and now all that space that will add additional space, not only just boat and RV once we fence it, but we have the ability to add more square footage out there with portable units, shipping containers and portables that we'll put out and expand it even further once we lease it out.
Nice. Very good. Good. Well, it looks like Jim popped on there. He's the next question. Jim, do you want to ask your?
I better answer it correctly.
Right.
Truthfully and correctly, and flat-footed. No making things up. Go ahead, Jim.
Sure, I'll ask my question. I think we do have you on the podcast coming up early next month. I don't remember the exact date. But one of the questions I think I asked you then is, you mentioned the growth over the past 20 years in self-storage. I look, whenever there's a new multifamily place coming in anywhere in my neighborhood, it has a self-storage component. There's lots of new self-storage. It's been this not underperforming, but kind of asset class that everyone says is great in recession, great not in a recession. Is it overbuilt? When is there going to be enough self-storage? It's got to peak at some point. It can't just keep growing. So what's your view on that? Yeah,
I'll answer it now the way I did on the podcast. And that is that, we sign on these things many times with our own personal credit. We bring our private equity partners along board with us. And we'll sign for a $5 to $7 to $20 million property that we're going to build. And if it doesn't lease up, there's a whole lot of folks that are going to be really, disappointed in us, our lenders and our investment partners. And if it fails, then guess what? I fail. I don't get to do business anymore. And as I said before, I'm unemployable. I can't go back and work for anybody else at this point. So we don't do this for fun or build it and hope and pray that they'll come. This isn't done without a ton of due diligence and feasibility studies. And looking at, I shared some of the metrics, that we look at: supply index, per capita, demand studies, rental rates, and it's all a math equation that we work backwards from. And if it doesn't pencil, it doesn't pencil. And then we move on to the next one. There is no hope. There is no praying that it's going to work. The numbers don't lie. You can drop me anywhere in the country and I can run through that math exercise in 30 minutes or so to determine at any given site whether it's going to work or not with the tools I have available on my laptop. And if it doesn't work, we go somewhere else. And so my point is, we're not doing this for fun. We're not a bunch of self-storage development cowboys out there, just competing against each other and just building it and assuming they will come. That happened in the 70s and 80s, and it did because there was no competition, but not anymore. So when you see them going up, it's by a whole bunch. They're being built by myself and a whole bunch of smart folks that know what we're doing. Nobody puts up a Starbucks unless they've done a market study to determine whether that's going to happen. None of this stuff happens without a whole lot of homework behind it. So that's the best way I would answer it. It's where supply meets demand. And if there is no demand, then we wouldn't be building them. But there's demand. We're still, to this day, Jim, we're still trying to catch up in terms of development. We're behind from the Great Recession and the demand that was created. And now our house sizes, before the Great Recession, in 2007, average home size in the US was 2,293 square feet, 2,293. And now we're at 1,983, almost exactly. Well, that was a number I saw, 300 square feet less that we've been building since then. We're a society that is migrational based. Everybody's migrating to the South because companies realize you don't have to live next to your corporate headquarters and drive in anymore. And so people are free to work from home. So guess what? Their home is changing. They're going south. They're going where it's warm. They're going back home to wherever home was. And so that is also feeling the need for growth. And the baby boomers, they're passing on. They've been downsizing and then passing on, going to assisted living facility, and all of that necessitates a need for storage. So the industry is strong, and there's a number of demand factors that are continuing to bolster it. And we don't see it's human nature to store stuff, and that's not going to slow down anytime soon or change.
Excellent. Thanks for that. And I just want to say one more thing, just so it's clear. We did not want you to come out and present a deal, and you didn't. Thank you for that. But we are not so strict. We do want people to know that you have offerings. So if you want to mention if you have a fund or not a fund, and just tell people how they can get in touch with you, and if they're interested in investing, how they do that. We want people to be able to do that. We just don't want people coming on and just being salesmen the whole time. So I just wanted to clarify that point, and I'll drop off after that. Thank you.
My wife has a dog. Let's start with that. That is for sale. She doesn't know it yet. We have a fund that we're rounding out right now. It's a $25 million fund, and the focus is on obviously self-storage, but nothing but value add, which means what's going into that fund has been and it is nothing but value add self-storage facilities, just like the one I showed you in Canton. That's going into the fund, and even that's a stretch because everything that we have has been cash flowing. This one does not. It cash flows, but we're adding the development on it with a loan. But the idea behind it, it's a value add, cash flowing distributions right out of the gate, quarterly distributions with an 8 pref and a projected IRR of 22 to 24%. And we're 1 year into that fund, projected to exit in 4 more years. We'll have another fund coming behind that. That'll be more of an opportunistic fund. And that will be a mixture of both development as well as acquisitions, because as we head into this recession, we know that there will be some developers that are going to be challenged and troubled. We saw last time a lot of partnerships that got strained and these developments that just got abandoned or short sailed. And so we're going to be doing a lot of that. And the fund has the ability to do some transactional funding to cover some shortfalls for some folks with the ability to take over properties and collateralize as well. We do have direct investments opportunities as well, meaning if it's like for now, for development projects, we got one that we're getting ready to buy in Wisconsin. We got 2 up there already that are underway, and that does not fit the fund parameters. And so that'll be just a direct investment. It may be for one person to write a check or a family office or multiple investors, but we're just inking that right now. And other opportunities along those lines as well. So we got multiple ways to be able to come and work and partner and invest alongside of us as well. But my contact information is there, and be happy to chat with anyone about what we got going on over here. It's a party over here at Kingdom Storage. We're just excited about the times.
That's great. Thanks for sharing that, Scott. Thanks.
My
Jim,
pleasure.
for calling that out. I'll jump back into the questions. We've got a few more that popped in here. How will you know when the pricing is too high? Can you talk about your study, how you study the pricing market?
I may need a clarification question behind that.
I don't know if that's rental or purchase. Michael, I don't know if you're.
I'm assuming purchase, because rental can never be too high. There you go. Unless maybe there's a fear that it'll come back down again. But yeah, another clarification behind that would be great.
Yeah, his follow-up is, are there any signals, metrics that would shift your perspective away from self-storage? So I assume it's purchase price.
Yeah, it's price and really demand study. If we find that it is maybe overbuilt right now, that sometimes developers will come in of self-storage. As Jim mentioned, anytime you see multifamily coming in, storage is right behind it, or sometimes self-storage may be ahead of it just because it's in the path of growth. I mean, we follow the same sewer lines, and we're going where the growth is, but we're also doing these infill locations as well. So, anytime we begin to just look into the market, it is a math exercise, at 85% occupancy at the current market rates, with this size square footage of a facility that we're looking to build or buy, what kind of income does that generate? Apply a 30 to 35% expense ratio. Here's what our NOI is, and where could we potentially exit and sell? That's one thing we look at, but at the end of the day, does it pencil out to build the thing? Here's how much it's going to cost per square foot. Here's the acquisition of the land or to do the conversion. And then here's the loan that we'll take. Here's the private equity putting on top of it. Here's our interest rates. Here's the IRR to our investors, the cost of our capital, our runway. all of those factors, we run it through our underwriting, and does it work? Does it make sense? And if we sell it, we're going to break even, and our investors get a great IRR. Well, we're not going to do it for that unless we're all making money. And so that's when we walk away. It's just, it is a math exercise. How much does it cost to build it? How long will it take? And how much rent will we get from it when we fill it up? And then, again, how long, what is the internal rate of return? How long will it take to get there? And if supply index is low to begin with, guess what? Rental rates, high to begin with. And guess what? Rental rates probably are as well. And it probably just doesn't work. So there's a number of boxes, that we look at. And, if they, if we tick them in the positive direction, we keep going down. But there's a few things. And just even acquisition side, if there's functional obsolescence in some of these sites, if it's concrete, made with split block, and they have nothing but the narrow doors and 5x5 units. Yeah, that worked in 1978, but now, people want 10 by 15, 10 by 20, and we keep wanting larger sizes. So if we buy a facility that has a whole bunch of 5x5s, and they're offering them half off or giving them away free for a 10 by 15, it's only going to get worse. And so we may walk away from that. There was a river underneath one of mine, one that I looked at. I didn't buy it. It was a culvert. There was literally a river running through and underneath the facility. So we walked away from that one as well. So there's a few things to look at.
Makes sense. Next one related to the idea of there being an anchor tenant, asking how do the tenants usually feel about there being a self-storage in the shopping center with them? Do you run into much blowback from either anchor tenants or even neighboring tenants if you're building in the area? What's that generally like?
No, I mean, they have, everybody has the opportunity to voice their concern, if we're going through a variance for zoning, and they can show up and raise their hand. But usually we're going to win out those arguments because we're a pretty quiet neighbor. Very little to no noise, very low drag on the utilities. There's, people drop their stuff off and we don't see them for 13 months. There's, low traffic period, foot traffic, driving traffic. From a development standpoint, it's really easy to sell to the city. It's just not a drag on anything, noise or otherwise. If it's next to a neighborhood, they don't like it necessarily to see the doors if we're building, single story or whatever. They want to have some buffers or, 6 foot tall split block, fence around it or what have you. And they can, put up some remonstrance. But in a shopping center or anything like that, those anchor tenant, if it's an anchor tenant that's in there and we're building out the rest of it, they're thankful because they're afraid that landlord's going to lose out and they're going to be out, and if it just brings more traffic at all to the site, it just helps them. So if anything, everybody's usually happy in that instance that it's being repurposed because nobody likes to see anything go vacant or stay vacant because that just perpetuates. It's just a snowball.
That's good. Yeah, makes sense. Next one was, how do you assess future development risk from competition, or how do you analyze that typically?
Yeah, same thing. Feasibility study. I mean, we start with the third party feasibility, and we take a look at the market. We're looking at the growth. We can see the trajectory. We can look at the city's projections. We can see what's planned. We obviously, I'll always go down to zoning department to see, what is in the planning stages, what has been permitted, how many houses are coming in, multifamily coming in. And, is there a decline in the population? Is there a decline in rental rates of rental real estate in terms of residential, habitational, looking at the competition? We shop our competition, but we don't really shop them. I can't really hide. I can't pretend. I can't go shop because most people have seen me if they've been to any trade show or read any article on self-storage is written by me, or, it's been comes out of our shop. So I just walk in and say, hey, how's biz? And what's the market like? And are any of your competitors interested in selling that you know of? And just begin asking questions about the market to find out as much as I can. So we, it's not difficult to get the proper data that we need in order to feel comfortable moving forward or not.
Makes sense. Shane asked, your case study is a purchase in cash. Is that a standard strategy for your asset acquisitions?
No, it's not. That was, when we have a fund or $25 million fund, or any fund for that matter, you're always balancing how much cash you're bringing in. You need to deploy it. And we deploy ours by leveraging it on top of debt. But at this point, we just had a whole lot of cash that we purchased it in cash, and then we backed in. And they wanted to sell it. They weren't waiting for us to raise the capital and get all of our construction studies done. That would have been, it's a 6-month process. And if we go into contract with something, they want to close it in 90 days. That's typical for a commercial transaction. So we bought in cash, and then we backfilled it with the fund, and then put debt on it afterwards.
Gotcha.
So sometimes we do that, but that is not typical.
Okay. And that kind of speaks to the rest of his question of, do you anticipate cash out refinancing debt structure on those assets later? And if so, how does that work with respect to investor return?
We do. So we'll refinance out of those at the right time, and then make the appropriate distributions pro rata by shares to the investors, and then with the ultimate, the rest of the equity then being exercised when we exit in that 5-year time frame. We have within this fund, we were able to wash some of that money by selling some of the assets off. We hit our 5-year targets in a year, and so we sold them and just washed that money again. So our returns out of our fund we're way ahead of schedule. If we don't blow our projections, I'd be shocked, because we've already washed several $1 million of that cash already. It's back into play again.
Great. Yeah. So that kind of speaks to the next question. You're selling these assets. You aren't holding these forever, refinancing them and holding them. You sell them.
We're not. We're in the business of producing high returns that allows us to raise capital in a much faster fashion. We could set up like a debt fund or just refinance and hold forever, but then we're like the rest of the funds out there offering 12 to 13%. And that doesn't usually offer a lot of opportunities for repeat investors. So when we consistently perform, not at 12 to 13, but we consistently perform at 20 or above, that allows us to raise capital quickly and go out and take advantage of the market, so that we can get more projects and more properties, so that we don't miss out like I did back in 2009 and 2010. So just a little different business model.
Yep. In the fund that you have, or the multiple funds, how many triple net lease deals do you have in there? How many of those anchor tenants are around?
Very few. That, like I said, that's rare. We're usually buying that. We're buying that big shop and then building out the rest. I can't honestly think of another one. I don't think we have any other triple nets from an anchor where we're building out the rest or anything along those lines right now. We have in the past that we've sold. I don't have anything in the fund or anything existing in our portfolio in or out of the fund right now that is a triple net with a larger player. Yeah.
Okay.
I've got, we don't have anything like that. We've got some other tenants in some commercial spaces, but nothing like that.
And the last one sitting here says, can you talk about your financing again? Can you walk through kind of how you set your debt and everything else?
Yeah, our debt is we're below 60. We will never take a loan above 65% LTV, and which is really easy on the development side because banks won't go higher than that. Especially right now, they're backing it down to about 60. But on the acquisition side, it's never above 65%. We're still getting debt in the 5.5% range. We're in a really good position, not only ourselves because we kept our nose clean and done well, but the banks right now are clamoring for self-storage deals because they want to bolster their balance sheets, and they're building it up, and so they want to have as much self-storage as possible on their balance sheet so they can continue to get money from the feds because it does so well during a recession. And so some of the feds have even said, hey, you need to get self-storage on your balance sheet. So it's not a heavy lift to get a loan for us on a self-storage facility right now, and we're getting really strong rates. It's getting really, really competitive amongst the banks to fund self-storage projects. So that has been I don't want to say a breeze, but we have no shortage of lenders that are knocking on our door to lend on our self-storage projects.
Is that fixed rates usually? Or
fixed. No, we do nothing variable. No.
Okay, good. And then another one popped up. Ryan's asking, tagging on to some of the earlier questions. What do you see as the timeline for opportunity in the asset class before it comes overbuilt or prices are driven beyond what it makes sense and that sort of thing? What's the horizon feel like to you?
Well, I've been at this 30 years and I've been studying it since I went back as an industry in the 70s or 80s. And you may find a pocket here and there in the country where there are some rogue developers or a city that didn't really keep an eye on zoning, and they may have let a few too many facilities in to compete against each other, and they'll have rates that may be soft for a little while. But I don't see any need for saturation. Our development is not keeping up with the demand or even the population at this point. So certainly not in my lifetime, or I shouldn't say that. Certainly not in the time that I will slow down and not invest any longer. So I believe it's going to stay strong, very robust for a number of years to come. And internationally, self-storage is just now becoming a thing. Many parts of the world, It is, again, very similar to what we saw here in the US back in the 70s and 80s. So as the middle class is being created throughout the rest of the world in many areas, there's a huge demand for storage. So plenty to do here in the US, even more opportunity worldwide right now.
That's great. Very good. That's the end of the questions I see on the list, and we're right up against.
And it's 1 o'clock. Well done, guys.
Yeah, yes, exactly. But Scott, once again, really want to thank you for coming on. Thank you for your kind words.
My pleasure. Thanks, Chad.
Field as well. We really have enjoyed our discussions with you and so forth. So we look forward to more conversation, more business in the future as well.
I'm looking forward to it. Thanks, Chad. Thanks, Jim. Thanks, everyone. See y'all very soon. Have a great day.
Thank you, everybody, for attending. We'll talk to you later.